Welcome to another episode of the brand called You, a podcast and podcast show that brings you leadership lessons, knowledge, experience, and wisdom from thousands of successful individuals from around the world. I'm your host, Ashutosh Garg, and today I'm delighted to welcome a very senior professional and an author with a deep understanding of finance from USA, Mr. Steve Lawson. Steve, welcome to the show.
Thank you so much for having me. I appreciate it.
Thank you. Steve is an author of a book titled Wealth Highway, Your Roadmap to Financial Freedom. He's the founder of an organization or an entity called Unbroken Investing. So, Steve, before we come to your book, tell me a little bit about your journey and what first made you interested in investing.
Well, it's funny. I've always been interested in investing. Actually, I went to college and had a degree in accounting and finance. And my first job for 10 years out of college was in financial planning. So helping people invest in stocks, bonds, funds. I've just always found that fascinating.
Very interesting. Okay. And when did you realize traditional investing was too slow?
Well, so I spent about 10 years doing traditional investing. And during that time, keep in mind, that was the 90s, we had the greatest bull run in market history. Again, stocks just went up record amounts year after year in 95, 96, up until 2002. And then we had the dot-com bubble burst.
Yeah.
And what I realized by the end of 2002, most people were right back to where they were 10 years before. They made no progress. And that's when I realized there's got to be a better way than traditional stock market investing. And so that's when I made the transition into real estate at that time to help people create wealth with real estate instead of the stock market.
And what would you say was one of your biggest financial mistakes early on? And what changed when you shifted your focus to cash flow?
Well, sure. Well, first of all, like everybody else, I depend on the stock market and hey, this is how you're supposed to create wealth. You put money in, you dollar cost average, you build your portfolio. And so that was one of the mistakes I made. And then when I switched over to real estate, funny thing is, for the first 10 years, I showed people how to create wealth in real estate, and it worked really well, but I didn't do it with my own money. I was showing people how to do it. I just wasn't even following my own advice. And so once I started following my own advice, made a big difference. And then once I really made that mental transition from, I don't need assets, I need cash flow, that's really when things took off and had the biggest impact on my overall picture.
Very interesting. Steve, you're an author of a book titled Wealth Highway, Your Roadmap to Financial Freedom. Tell me about your book and what made you write this book.
So over the years, again, I've worked with investors. I've been working with investors for over 30 years now. And when I found something that was unique and different, I said, you know what? I need to show people how this worked. It worked really well for me in a short period of time. I mean, the difference in less than 5 years from when I started almost with nothing again and built passive cash flow within 5 years, I started showing people how to do that. And I'd been doing that with coaching, with one-on-one. I'm like, I want to get this word out to more people. And so that's when I decided I think a book would be helpful because it's going to reach a larger audience and show them how to have this mind shift change and this change in their financial future.
Very interesting. Your book is written as a road trip conversation rather than a textbook. Why did you choose storytelling instead of a traditional finance manual?
It's funny you say that. I've always been a numbers guy. Again, I go back to college, accounting and finance. I've just always been a numbers guy. And so over the years, I spent a lot of time showing people, here's the data, here's this, here's the analysis. And most people that look at that and just kind of, what am I supposed to do? And so I over the years, I got better at showing people illustrations of what they need to do as opposed to just the numbers. And I just kind of took that next step with that. It's like, let's make this a story where we discuss how you do things and what needs to be done in more of a story format. It's easier to read, easier to understand for most people.
Amazing. You talk about the 5 levels of financial freedom. Tell me about these levels, and if you can give me an anecdote or a story that'll help us understand them.
Sure. Well, so the way I look at it, everybody is on one of these 5 levels. I mean, the bottom level, you are spending more money than you're making every month. That's bad. That is the worst level. You need to get off that level as soon as possible.
Correct.
And up on level 5, you have all the money you need to cover all your expenses for the rest of your life without having to worry about anything. You got inflation, diversification, everything's taken care of. And most of us are somewhere, on 2, 3, or 4.
Right.
And so I kind of created that as a way of helping people understand where they are and what is next, instead of people thinking, oh my gosh, I don't have any money, I'm broke, I've got my investment portfolio is $500. I'm never going to achieve financial freedom. I use the example a lot. How do you eat an elephant? One bite at a time. And when they're looking at the entire elephant, that's intimidating. But when you kind of break it down and say, all right, we're just going to start with this piece, they're like, oh, well, I can get from level 1 to 2. Well, I can get from level 2 to 3. And you break it down that way, it's easier for people to understand and see what that next step is instead of being intimidated with how do you get all the way to the end from where you are.
You describe level 1 as drowning.
Mhm.
What do most people most commonly misunderstand about being financially underwater?
Yeah, so the big thing is understanding, again, level 1, I call it drowning because you're spending more money than you make.
Yeah.
And it's unfortunate how many Americans are in that position with credit card debt and things like that, and the whole buy now, pay later, thing that you see so much these days. And people are just putting themselves in a worse position on a regular basis. But what they don't realize is they're spending a huge amount on interest that they don't have to be spending.
Yeah.
And if you eliminate that, I mean, you'd be amazed if you were to look at some people's budgets, the monthly amount they spend on interest alone on their debt. So imagine all that going away, how much cash that would free up.
Correct.
But also, it's your credit score. And so when you go to borrow money, if you have a lot of debt, if you have unstable job, unstable payment history, all those things impact your credit score, which makes it harder to get money and things like that. But what a lot of people don't realize is, like insurance companies, they will actually look at your credit score to determine how much insurance premium you pay. And they look at this and go, oh, you've got a low credit score, you're a high risk, we're going to charge you more for insurance.
Correct.
And so it's not even just the interest rates that you're paying and the amount you're paying to that, it's got other consequences. And I can't confirm this, but I've heard rumors that there are people that when they interview for jobs, they actually are able to look at credit scores because they're looking at that as an indicator as to how responsible this person is.
Wow.
And so your financial picture doesn't just impact your monthly budget, it impacts your insurance, potentially jobs, and other things.
Very interesting. Your simplified budgeting system divides expenses into essential and fun. Why do most budgets fail, and why does simplicity win?
Sure. So if you look at if you were to ask someone, how do you create a household budget? You're going to have your house payment, your car payment, your utilities. And they're going to have this, maybe they're doing a spreadsheet. They got line by line by line. All right, how much for food, how much groceries, how much for meals out, how much for entertainment, how much for clothing, all these different things. And they're trying to say, oh, my clothing budget is $400 a month. Oh, they had a shopping spree. Last month they only spent 200. Does that mean they can spend more next month? I mean, it gets complicated line by line by line. And what happens is even people with the best of intentions, they may create this budget, but they just don't stick with it. It's too much time. It's too complicated. And after a few months, most people are like, I'll do it some other way. And so when you break it down into just what you have to spend and what spending on money, things you have to buy, your house payment, your car payment, your insurance, utilities. Okay. And then you've got the stuff that you want to do. Maybe you like Broadway shows. My wife and I do a lot of those. All right. We have a budget. That's part of our fun budget. Going out to nice dinners, travel. All right. So that's your fun budget. And when you break it down into just those two things, it makes things a lot easier. And so maybe, if you really like shoes, maybe that's part of your fun budget, But then what happens is when you go to buy your next car, you're looking at this really fancy car that's $800 a month. And then you're looking at this other car that's very reasonable, that's $400 a month. And you say, well, wait a minute. If I can save $400 on my essential budget, because I have to have a car, that's $400 more I can put towards my fun budget. And that's when people start going, oh, wait a minute. Okay, this is easier, but I see how budgeting and saving money over here can help me do more of the fun stuff.
Great response. You also say that the biggest shift from level 2 to level 3 is adopting a cash flow first mindset. Why is this shift more psychological than mathematical?
Well, a lot of it has to do with what has been drilled into our brains for decades. And again, you look at advertisements or you go research investments and what pops up. it's all stock market investing.
Yeah.
That's what's been drilled into us. They spend billions and billions of dollars a year. And again, I have a Fidelity account. I love Fidelity. That's one of my favorites. Edward Jones, Charles Schwab. Most of these are great companies, but they spend a ton of money advertising and telling you what to expect. Okay. Hey, a 10 to 12% return is a good return. And so that's what's been drilled into people for years and years and years. And they all have, a lot of them have used what they call a magic number. Hey, once you build your assets to this, then you've got financial freedom and we're going to help you build your assets. And so that whole concept of I just need to build this big pile has been drilled into us for decades. And if you think about it from this standpoint, though, I usually use gold as an analogy and say, okay, they're telling you to let's say they tell you to build a huge pile of gold, and it's a bunch of gold coins sitting there. When you retire, every time you go to spend something, to go to buy something, to pay your house payment, your car payment, or food, you have to take a gold coin off that pile and go spend it. And you have to hope the pile lasts long enough. And so that's kind of the pile mentality that they've been teaching us for years. But the cash flow mentality is you get that golden goose, or I guess you get a goose that lays a golden egg every day. Yeah. And as long as you spend within that budget, then you're fine.
Absolutely.
And so when you look at it from that standpoint, all your expenses come in monthly. Your house payment, your car payment, utilities, all those things are monthly expenses. You just need the passive cash flow to cover those expenses.
Very interesting. You critique the traditional retirement magic number approach.
Yeah.
What are the biggest assumptions embedded in that model?
Sure. So what they're doing, and again, I was a financial advisor for 10 years, so I use that model quite a bit. And what they're doing is they're saying, okay, here's how much you have today, and let's assume you're going to add this much every month. Let's say you're going to add $1,000 a month to your portfolio, and let's assume that it grows at this rate. And let's assume inflation averages this much. This is how much you'll have when you retire at 65. And let's assume your expenses are going to be this much during retirement. And let's assume you're going to live to the average life expectancy, which is 83. And so as long as all those things happen, and as long as you die on time, you'll have enough money. There's a lot of assumptions built into that mathematical model. And if you think about this, what about the people who followed that model for 30 years and they retired in 2020, right before COVID, right before inflation shot up, and they budgeted a certain amount because this is what we think we're going to need to live on every month. And then inflation hit, and 3 years later, that wasn't enough. They budgeted based on an assumption made 20 years ago. Hey, I hit my magic number. Now I can retire. But something changed during retirement, and now they can't make the payments. And so there's just a lot of assumptions in there.
Yeah, very interesting. A few minutes back, you were speaking about the golden coins. And I wanted to ask you about your golden goose metaphor, because you say live off the eggs, don't kill the goose. How should investors apply this in a volatile market? Because, you can't just wait for the one egg to come. Your temptation is to take out all the eggs from the stomach of the goose.
Right. So you got a couple things. One is, where are you now? So in other words, if you're 35 years old and you're going to retire in 10 or 20 years or whatever that is, then, the answer is very different. Again, if you're getting cash flow from your goose, you're reinvesting all that back into your other investments anyway. So it doesn't really have a big impact. If you're retired and you're living off that golden egg every day, not much changes when there's market volatility. So if you think about it, let's say that again, you retire with $1 million and you're earning 12% interest in some private lending. And so every month you're getting 1%. So 12% a year divided by 12, you're getting 1% a month. So 1% of $1 million is $10,000.
Correct.
Awesome. You're getting $10,000 to cover your budget. And the stock market drops 20%. Doesn't matter. Your cash flow of 10,000 doesn't change. It's not tied to that. And that's the whole point is, at that point, whether the stock market goes down 20% or up 20%, it doesn't really have an impact on you. You've built your retirement, your financial freedom around cash flow that's coming in regardless of what the market does. So
very interesting.
I think I answered your question there, but
you did.
Oh, did I? Okay.
I was just thinking, sometimes the temptation to be able to just live off next month's egg or borrow against next month's egg is always there. But I think
True.
you've cautioned us enough
Yeah.
about that, and you said only live within your means. You also recommend three accounts: essential, fun, and investment. Why
Yeah.
is
And again,
sorry?
sorry, go ahead. Yeah.
Why is a behavioral separation more important than a spreadsheet optimization?
Sure. So, and again, the first example I gave, if you're on level one and you're drowning in debt, obviously you're
Yeah.
not even worried about investing. So you just got the two buckets, essential and fun.
Yeah.
But once you get into a better financial position, you can start investing. You create that third bucket, which is again for your investments. And so, you may have every time money comes in every month from your job, you may have 50% go to essential, 40% to your fun stuff, and maybe 10% to investing.
Hmm.
And what you can even do is you can automate that so you don't have to think about it.
Hmm.
Use three different bank accounts, and so you get paid on a certain time, and you can set up your systems to automatically move X dollars into your fund account and Y dollars into your investing account. You don't
Hmm.
even have to think about it.
Yeah.
And you pay your automated expenses out of over here, and
Hmm.
you've got whatever's in your fund account. That's what you have to spend on fun. And
Hmm.
now you don't even have to think about it. And that is much easier. You talk about from a psychology standpoint than trying to remember what to do, trying to, oh well, gosh, should I do this or shouldn't do this? You look at what's in the account, and that's what you have to spend, and
Hmm.
it really kind of simplifies the whole emotional part of it.
Hmm. Very interesting. You also argue that most people diversify incorrectly, you know, have different stocks in the same basket. How should investors think about non-correlated assets?
Yeah, great question. So I'll talk about the way most people think of it first. I've talked to people who say, hey, I'm diversified. I've got tech stocks and healthcare stocks and bank stocks and utility stocks. Well,
Yeah,
that sounds great, but most stocks go up and down together. When the market
correct.
crashes, they pretty much all go down.
Yeah.
So that's not diversified.
Hmm.
Okay. And non-correlated is just a fancy word for not related. So what you want returns that are not related to the stock market, so
Hmm.
that when the stock market goes up or down, it doesn't really impact your returns. I gave the example earlier of a fixed return.
Yeah.
If you're making 12% a year and the stock market drops 20% a year or 20%, doesn't matter. You're still making that 12%.
Yeah.
That's not correlated. There's no connection there between the two. And
Hmm.
so one of the good examples is in 2022, we had really high inflation. The stock market dropped 20 to
Yeah.
30%. And most people can remember what happened at the grocery store to the
Correct.
grocery prices. They skyrocketed.
Yeah.
Well, one of the asset classes we recommend is agriculture. And
Hmm.
so in 2022, my cash flow from my walnuts, coffee, oranges, what else? Mangoes,
Hmm.
cash flow from all those went up with inflation, not down with the stock market. And that's
Right.
called non-correlated. It had no connection
Hmm.
with the stock
Hmm.
market.
Hmm.
That's how to think about diversification is,
Hmm.
does the up and down of the stock market have an impact on the performance of this asset?
Hmm. Very interesting. You also compare building wealth to starting a fire, paper first and then logs.
Mhm.
How should beginners apply your sequencing logic?
Sure. Now, I just mentioned agriculture, which I love, but there's pros and cons.
Hmm.
So let's say you go plant coffee trees. Well, that's going to generate you income for years, usually about 25 years, give or take a few. They last quite a while. That's great, but you don't get any cash flow for the first 3 to 4 years. The
Hmm.
plant has to grow, get old enough to have its first harvest, and then even then, it's still pretty small.
Hmm.
After you're 5, 6, it just keeps getting bigger and bigger. You get more and more harvest, more and more cash flow.
Hmm.
And so if let's say you had a fixed amount to invest and you invested in that first, that's long term. I mean, that's a long term cash flow. You get nothing for 3 or 4 years.
Yeah.
That money's tied up, it's gone, it's not doing anything. Whereas if you put that same investment into something that's higher burning, that we call it, it's got a higher return. It may not
Hmm.
last as long, but maybe you're getting a huge return for 5 or 6 or 7 years.
Correct.
Well, within a year or two,
Hmm.
the high cash flow from that asset can buy that same amount of coffee, or
Hmm.
coffee plantation, and then maybe
Hmm.
in year three you can do it again. And so what happens is you're getting cash flow and returns from something that burns it burns really hot, high return, it just may not last as long. But that generates all this cash flow that you can then use to invest in other things and build your overall portfolio faster.
Very interesting. Steve, I have time for two more questions.
Sure.
Level 5 doesn't mean yachts and retirement. It means optional work. Why is choice the real definition of wealth and not just the fact that you have a lot of it?
Yeah, and I talk about that in my book. One of the first things I have to address is, hey, we're going to help you get to financial freedom.
Yeah.
What's financial freedom? Basically, it's that freedom where you decide if you work, when you work, and what you do. I mean, every day you can decide, hey, I don't want to work today. I'm going to go play golf. I'm going to go for me, I'll go for a bike ride, go for a hike. Freedom is being able to decide what you do, when you do it, and where you do it. That's freedom. And so that is more important than just, hey, I've got yachts. So it's just a different perspective of when I think of freedom, it's the ability to do what you want, but it's also the freedom from the stress of financial that finances can often cause.
Yeah. Though on a lighter note, if you have yachts, that's the quickest way to reach level 1.
Probably. Yeah.
My last question.
So real quick, you say that. I worked with, it's funny because I worked with, some people who've never made much money. I worked with a guy in particular. He'd never made more than $30,000 in a year, but this was quite a while ago, but he had put all his money into paying off his house. He started a little business in his garage and he was debt-free, happy, and doing what he liked every day and had no financial stress. I've also worked with doctors making hundreds of thousands of dollars a year who feel like they should have that yacht, they should be on that vacation, live in the nicest homes, and they don't know if they're going to be able to cover their expenses next month.
Yeah.
And so that's why I talk about the financial stress and the financial freedom is more than just how much you have.
Absolutely. And my last question for you, Steve. Many financially free people continue to work. Why is purpose more important or more powerful than money?
Well, there's a couple parts to that. And one of those is if you look at, as a matter of fact, there's a special not that long ago about people who live the longest. What was it called? The 5 Blue. I forget what it's called. I apologize. But basically is where people were living to like 100 years old. And almost every one of them, they said, I have a purpose. I get up every morning. I have something to do. I have a reason to be alive, and it motivates them and keeps them going. And that could be work. It could be volunteer. It could be something else. A couple of things, gardening. I love gardening. That's what I do. I get up every morning to garden. And so one way or another, you need to have a purpose.
Correct.
And again, if it's not a job, it's something. And so without a purpose, I'm not sure what you're doing.
Correct. And on that note, Steve, I just want to say, what a fascinating conversation this has been. As you were talking, I was reminded of a very famous statement of Richard Branson, who was the founder chairman of Virgin Airlines and Virgin Atlantic and a whole lot of others. He was asked a question, how do you become a millionaire? And he said that, well, you make $1 billion and then start an airline. So you become a millionaire because airlines tend to lose money. But there's the other well-known adage is that a penny saved is a penny earned. Talking to you has given such an amazing perspective on how important it is to be able to manage wealth, to be able to manage our own resources, and to be able to plan, because we never know what life will throw, or as you say in America, what curveball life will throw at us. Thank you for sharing some amazing thoughts with me and my audience, and all the very best to you.
Awesome. Thank you so much. I appreciate your time.
Thank you. Thank you for listening to the Brand Called You videocast and podcast, a platform that brings you knowledge, experience, and wisdom of hundreds of successful individuals from around the world. Do visit our website www.tbcy.in to watch and listen to the stories of many more individuals. You can also follow us on YouTube, Facebook, Instagram, and Twitter. Just search for the Brand Called You.